Well, from the wild world of crypto to the wild world of traditional investments. Well, it might seem that way as inflation remains stubbornly high with the promise of even higher interest rates. Yet, unemployment is so low both here and around the world. Let's bring in Perpetual's Head of Investment Strategy, Matt Sherwood. Matt, always good to have you on the program. I want to take you to that exact point. This time around, as compared with previous recessions, the difference is the unemployment rate is so low, which means consumers can absorb price rises from the higher inflation. That means while unemployment is so low, that employees are actually growing their businesses, looking for more labour. This is the disconnect to me for the investment markets.
Yeah, it's a much more complicated cycle this time, Ross. And the way I like to think about it when I'm talking about it with my clients is to think of the economy in terms of a train. Right at the head of the train are the surveys, so the PMIs, the ISM sort of thing. Policymakers are right behind them. And then about 2 or 3 stations back is unemployment and inflation. So they are lagging indicators, and there's no doubt around the world that unemployment is very, very low. Interest rates are rising aggressively, and as you said, inflation is at 40-year highs and double-digit in some countries. And it seems somewhat inconsistent, the signs that we're seeing, but I think the labour market and inflation are the lagging indicators. I think their unemployment's going to go up next year when we see the impact of the policy tightening begin to hit household spending. That's going to be the key. There's always a lag there of about 1 to 2 years. So to me, it's looking like a 2023 story.
Okay, but then it comes back to earnings, because the stock market always follows the earnings of companies. Because what it says to me is right now the earnings of the companies might be okay, but there almost looks like there's a brick wall approaching very, very quickly. If what you say is right, that the interest rates eventually catch up, that eventually the employers stop employing. Now, that also means their earnings are going to be clipped at some time down the track, which means that the euphoria right now of markets rising as the expectation of lower interest rate rises in the future is coming around, that might be a bit of a false dawn.
Yeah, I've been very surprised how well the market has hung together, just given how aggressive these rate hikes, not only from the RBA, but also from the US Fed and all of their global peers have actually been. Yes, the market's off, quite substantially this year, between 15 to 20% globally, but I actually think they've held in quite well. And I think the story this year has been falling valuations as real interest rates rise. The story next year is going to be the impact of those higher interest rates on earnings growth. So our suspicion is next year we're going to get a bunch of rolling recessions, and that's going to weigh, as you say, very heavily on the earnings outlook. And on average, an average US recession leads to a 20% decline in earnings, and analysts at the moment have got earnings growing 7%, not only growing, but growing above average. And to me, that's just not sustainable. I can't imagine that being resolved, particularly with all these cost side pressures still there, which are squeezing margins. So there is going to be a catch up between where the markets are at and where the corporate earnings are at. At the moment, it's hanging in there. You only have to look at the last US reporting season, or the current one, I should say. Expectations coming in were for about 3% earnings growth. It was a bit less, but it was still positive. Take energy out, though, expectations were -3%, delivery was -5%. So to me, I think the tracks now are starting to get laid of where corporate earnings are heading.
Okay, so you make the point there that earnings per share growth, or earnings growth, if you like, profit growth, that's the key to drive the stock market. Now, you've put a couple of charts together for us today. We go to the first one, and this one is really about the global earnings, because it actually shows there's a correlation between share price movements and really where the earnings and the earnings growth is. So it's not just the earnings, it's actually the growth in the earnings that's the key.
Absolutely. And what the model is showing here is that by the middle of next year, earnings for the MSCI World Index, the model estimates are going to be -12%. Expectations, as I said before, are about 6 or 7% up. This is saying down. So that's starting to be a pretty big earnings disconnect. And there's two things which drive markets, which are valuations and earnings. And to me, this is where the mispricing is actually at. And we already know that Europe and the UK are heading into recession right now. The big drag by the middle of next year on global earnings is, in fact, Europe. Our model for that is at minus 22%. Other regions, such as America, aren't as bad. And that's simply because the labour market hasn't been broken yet by the Fed. And we suspect that's a story for the second half of next year. And that's where we start to see the earnings recalibrations and material downside risk from here.
Okay, so then we bring it back to Australia, because at the moment, Australia is aiming for the so-called soft landing. That would be the preferred approach of the Reserve Bank. So we have a look at exactly the same chart we just showed you on a global basis. Your chart is now showing Australian earnings per share growth versus where the stock market is. And what this implies right now is that there is a big earnings cliff coming, and that would imply that, all things being equal, the stock market should follow that down.
Yeah, well, there is an earnings decline coming, but it's not as bad as what we're seeing globally. And what's helping the Australian market, at least, is the fact that the exchange rate is seriously depreciating. And what that means, well, it's depreciating relative to where it was 12 months ago. And that does give some support, particularly for our global earners. But in the end, Australia's going to be caught in the same wash that most other markets are in at the moment. Growth is slowing. Interest rates are going to grip the economy next year, particularly in the second half. And as a result, corporate performance is going to be under pretty serious scrutiny, both from the revenue line, but also because a lot of these cost side pressures are going to be there for an extended period. And as a result, it's not only lower earnings, but particularly driven by lower margins. Australia does have a couple of advantages. Our economy probably looks a little bit strong. I think the RBA is nearly done. So I tend to think there's only probably 2 more rate increases here at the most. That gives us a better chance of a soft landing relative to other global markets like the US, Europe and the UK. But I think relative to other cycles and tightening cycles by the RBA, recession risks here are probably a bit more elevated than what they have been in the past. And that's because the state of household balance sheets in Australia is not good. It's very, very leveraged. And that means RBA policy has a much bigger impact on household spending decisions when those borrowers move off the fixed rates onto the variable rates. That will lift their interest rates from just over 2% to just under 6%. And that's a pretty significant hit to household disposable income. So we're going to see that in the second half of next year.
Perpetual's Head of Investment Strategy, Matt Sherwood. Always good to have in the program, Matt, and many thanks for time today.
Thanks for having me, Roscoe.